Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, markets, just a word on the markets. It's actually showing some bit of resistance to falling as well. It's not as if it's run away, but Bank Nifty, after dipping to a minus 0.3, is now again in flat terrain. So there clearly is buying at lower levels as well. We'll have to keep a close watch on the markets as well. But for the moment, let's invite another management. HOEC posted a good set of earnings in Q3 with strong revenue and margin growth. Production from Assam has added to revenues and bottom line. P Elango, Managing Director at HOEC, joins us now. Good morning, Mr. Elango. Thank you very much. It's been an outstanding performer, your stock as well. Before I come to the earnings itself, let me just ask you your outlook. Do you think that with margins going up, your order book gives you an indication that FY19 can be a good year?
Yes, indeed. Thank you. It's been a great quarter, both in terms of volume as well as in price. And going forward, the outlook looks fantastic because as we seek to add more volume, quarter after quarter, it's going to be a good quarters ahead.
Okay, Mr. Elango, good morning. Can you tell us what exactly was the gross volumes that you saw in this quarter, and what's the outlook as far as gas volumes are concerned as we head into the next few quarters?
Yes, gas volume overall compared to the previous quarter, we've increased it by roughly 60%. So we've delivered a volume of about 480,000 MMBTU in terms of the gas total net to HOEC. And what we anticipate as we ramp up the gas production from Assam, we expect from the first quarter of next year, we will be producing at full volume from Assam, which is about 1 million cubic meters of gas and about 1,000 barrels of condensate. Sure. As you know, in Assam, our stake participating interest is about 27%. IOC and Oil India being the remaining JV partners. Okay. So overall, from next year onwards, you would see at least a 3 times jump to the current quarter volume from Assam alone. Okay. We are also focusing on reviving our production from our offshore field in Kaveri offshore, where we hold 100% interest. We've already tied up with the rig and awarded contract. We expect to commence the drilling campaign in April 2018, and you would see production increase to come from the next quarter, Q2 of FY 18-19. Okay. We've also got the field development plan approved for our new block called B80 in Mumbai High, and that project will be under execution over the next 2 years. And we expect to commence production from that project from April 2000, that Q1 2020-21. So overall, our company's focus has been on ramping up production from Assam, which will happen by 1st April 2018, ramping up production from PY1 field, which will happen from 1st July 2018, and starting production from B80 that will happen from 1st April 2020. So these 3 projects together would take the company's what we call the operated production level to about 15,000 barrels of oil equivalent, compared to about 500 we did the last financial year. Okay. So it's a good growth ahead for us.
Mr. Elango, good morning. But do you see the company going back to its heydays? Say 4 years back. I'm not even talking about the 2007-8. Of course, those were golden years. But say 4 or 5 years back, the kind of profitability that you had for the full year?
Yeah, our vision is to really beat those golden days. And with the oil prices looking up and more, we're focusing more on the volumes growth really. With the kind of portfolio we have, where majority of the blocks, almost all the blocks have discovered resources, and we are very systematically focusing on monetizing one at a time. We have done it with Assam. I mean, the whole project in Assam will be complete by end of this financial year. As I told you, we were reviving the PY1 offshore as well as B80. Together, it would, our hope, it would surpass the golden days.
Okay. You know, what should a revenue run rate look like quarterly? I mean, there has been a jump this quarter, but year on year. But should we take, 15 crores as the revenue run rate? What should be the run rate?
Yeah, the run rate is the right way to look at it from 1st April of 2018, because by the time we would have completed the Assam project. So our revenue run rate per day would be about 40 lakhs per day, which is roughly about 12 crore a year and about 140 odd crores. Even if you take the operating costs, roughly about 30-40 crores. We are looking at Assam project alone contributing to about 100 crores next financial year full. And we are looking at from PY1 and other fields, another 50 crores coming to our top line. So on a 150 crore top line, our operating margins, Lata, is about 75% now. So we are looking at some healthy financial numbers from next financial year onwards.
Okay, what did you say would be the margin run rate you say for FY19, Mr. Elango?
Yes, 40 lakhs per day from Assam alone.
That's the revenue, but margin run rate, sir?
About 75% of that would be our operating margin.
Okay.
So we have a very high margin because the operating cost is very low, Lata, there in Assam. So we are looking at a operating margin in excess of 75%. So overall, our target is really in the next financial year to get a top line of about 150 crores, and 75% of that should go to our bottom line.
Okay, I think the street really likes what you're saying, because the stock has zoomed now. It's up almost about 11%. And just before we started the discussion, the stock was about 5% higher. So you said 150 crores revenue by FY19 with Assam plus the other projects put together. What does that do to your overall gas volumes? I mean, you're sitting at somewhere around 480,000 MMBTU right now. Over the next 1 to 2 years, what kind of gas volume growth can we expect?
So the gas volume growth, in terms of let's say our primary focus is on PY1 field, which is we hold 100% stake in the project. So we are looking at post the drilling campaign. Currently, we are doing about 2.5 million cubic feet. Post the drilling campaign, we are looking at 10 million cubic feet, which is about 4 times more than what we are currently producing from the PY1 offshore field, which is 100% participating interest of HOEC. Okay. In Assam, there will be a similar 4 times increase in the volume, but our share in Assam is only 27%. So roughly one can look at a similar, from a net revenue perspective, both PY1 and Assam together would be contributing roughly 90% of the revenue of HOEC in the next financial year, and the balance 10% coming from the other assets.
Okay. The last time you did revenue of 150 crore was in 2012. And at that time you did a PBT or PBDT of 100 crore. Is that what we are staring at?
Our target is to surpass that, Lata, in the next financial year. With the oil prices looking up, we remain confident. Okay. Of course, the cost base is very low. That's why we are
Sure. Lots of operating leverage. Take your point, sir. It was a pleasure speaking with you. Thank you very much for joining us with all those details. So that's a stock that's performed extremely well in the past 6 months.
Oh yes, remember, Lata, we've been talking about this as well about 2 weeks back.
I remember, Anuj, you were the first one to speak about it. I take your point on that.
So been a big move, of course. But let's move on and discuss some other stocks, because the market right now is looking quite interesting. I just want to point out Axis Bank. That stock right now is trading at the low point ahead of the numbers. So that's a little bit interesting right now, Lata. But you spoke to the Reliance CFO?
Yeah, actually it was just an ambush bite. It was Reliance earnings day, and we got him at, we got Alok Agarwal at the finance chief there at the risk awards, that function that we had. Just a very quick, he's normally not prone to giving sound bites, but he was ambushed and he stood and answered something on the Reliance Rel Jio IPO, if there was one. Just listen to the chat, it's a brief one. What is the risk of getting an IPO of Rel Jio this year?
When we look at risk management and Rui is the boss, IPOs don't figure into it.
Okay. No IPO this year. That's an opportunity. Exactly. I posed it as a risk, but I thought it was an opportunity. Well, when do we get that opportunity?
As they say, watch this space.
All right.
Okay, watch that space. Standard disclaimer that Reliance Industries owns Network 18 and TV18, the companies which operate CNBC TV18, the channel that you're watching right now. Reliance also owns RelGeo, as we all know. But on the sidelines of the same event, Lata also caught up with the renowned economist Nouriel Roubini, who is of the opinion that India should continue with the reforms initiated by the Modi government, and it should increase the pace of reforms if it has to accelerate the pace of growth to 7.5%. Listen in.
Now, one of the normal debates is, should the government increase the fiscal deficit and invest so that it can give growth a leg up? Would that be your advice?
My advice will be that, first of all, the budget deficit of India is still large at the central level, but also you have fiscal problem at the state and local level, and therefore fiscal prudence is necessary. And the risk is that even if you wanted to do a fiscal stimulus as a way of boosting economic activity, what you have observed in the last few months has been the long-term interest rates in India have gone higher, and have gone higher not just because of global factors, but more importantly because there was a concern that the fiscal deficits are too high. And even with the RBI marginally cutting policy rates, the impact on long-term interest rate has been just to slow down the rise of these long-term interest rates. And therefore, any positive impact on economic growth coming from a meaningful fiscal stimulus is going to be undone by a potential rise in long-term interest rates that's going to crowd out that recovery. Of course, the country is facing fiscal challenges also because when oil prices were falling, that reduction in oil prices were not transferred to the retail level, and it led to greater revenues for the government that were spent rather than saved in the good times. And now that oil prices are going higher, either you increase oil prices to maintain the same revenues, but if you do that politically a year before election, that's not something that's going to be appealing, and therefore the revenue is going to shrink and the budget deficit is going to be rising. That requires fiscal prudence, because otherwise you're going to have increasing long rates. Probably the way to square the cycle that you don't want to cut spending and revenues are falling and you don't have a larger budget deficit will be more divestments of state-owned enterprises and selling to market and partially privatizing some of those assets. That will be good for the economy, and it might be loosening up the budget constraint that the government is facing.
The other problem, the other debate that's constantly in India is the fate of our public sector banks. Up until recently, about 75% of the banking system was dominated by public sector banks. Now, of course, because of partly government policy and partly economic growth not coming good, we've seen them with a large number of bad loans, default loans. What would be your advice to the government of India?
Well, the first observation is, of course, part of the weakness in private, but even in public investment in infrastructure has been driven by the fact that you had a problem, a double problem. One, the banks having a large amount of non-performing assets and loans, especially these private sector banks, and then some parts of the corporate sector being loaded debt with too much debt that they could not pay, and therefore that was a situation that froze the ability to produce and invest. A good news has occurred, as you all know, is this passage of a new bankruptcy law that's going to allow essentially to clean up the balance sheets of the corporate sector, sell some of the assets to other investors, domestic or foreign, and then put them at work. Second thing you have to do on the other side is you also have to recapitalize these banks to make sure that then they can lend again, and that process is occurring. So that over time in the next 12 months is going to lead then to some positive creation of credit growth and ability to do more investment. But the reality is that there is no real strong fundamental reason for the public sector having a significant role in bank intermediation. If you don't want to fully privatize these banks, you could reduce your share from a controlling one to a maybe strategic but majority share to essentially partially privatize these banks and give them operational and financial independence so they can pursue maximization of returns, so that they are, even if they are publicly owned in partial term, they're subject to budget constraints and incentive like a private firm. So full privatization maybe is unlikely, but partial privatization and having this independence to pursue what's right should be the right thing to do, and maybe there's a possibility that India is going to go in that direction.
Okay. That's a hope for privatization of banks, which I thought was very important.
Okay. But let's move on. The market is doing quite okay actually at this point in time. Ashwini and Mitesh back with us. Prakash Gaba also joins us in our studios. Ashwini, thoughts on the trade so far? Looking quite okay. Advanced decline about 3:2. What would you trade on the index and individual stocks?
Well, I don't know what okay means. That used to be a soap in my time. But, you know, the market is not able to take highs of Friday out, which means that the bulls still don't have it in them to take the highs out. Reliance is kind of faltering at higher levels. And particularly on the banks, I think it's only HDFC Bank which is kind of holding on. So still it's choppy, and we have short positions on Bank Nifty, hoping that ICICI Bank and State Bank can come off a bit. See, we are sitting at a perch. Either we go up. If we can't go up, just the force of gravity could lead the market lower. Plus, you have 11,000. So don't take that point lightly, because each time this round numbers come in, there is some nervousness. Some people like to book profits, etc. So that needs to be kept in mind. I think Jaikumar Infra is a buy with a stop of 332, target of 354. Hindalco is a sell with a stop of 260, target of 235. And ICICI is a sell with a stop of 352, target of 336.
Okay. Well, we'll come back to you with more stocks, but let me get into the conversation as well. Morning again, Mitesh. What are you watching now?
So I think Adani Ports, has been kind of slightly unnoticed, but it's just getting past the earlier highs and making fresh highs. So I think that's clearly a stock which should be on the buy list. I would be a buyer here. Keep a stop at about levels of 435. Look for 460 as the target. And I spoke about ONGC in the morning. That's a buy. Keep a stop at 197 or just below it, and look for 212 as the short-term target.
Okay, those are your stocks. By the way, Dwarikesh Sugar and a couple of others from the sugar space are cracking hard now. Dwarikesh is down almost 8%, and so is Balrampur Chini. It's down about 4%. Dwarikesh Sugar actually posted losses in its sugar business this quarter. We'll talk about that in greater detail, but disappointing set coming in there. Prakash Gaba is also with us. Prakash, from the list of gainers, anything that catches your eye for a buy this morning?
Yes, certainly. I like few of the stocks. So far, Nifty is still looking okay. So I would go in start with Diwan Housing Finance. That looks good. Seen a good up move on Friday, and today it's continuing. I think the target on the upside is 635 to 640 zone. May take a day or two for that. Stop below 620 should be fine. I also like Kotak Mahindra Bank. That also did well. Today is encouraging. Possible target of the Kotak Mahindra Bank is in the vicinity of 1085 zones. Tight stop below 1060 should be fine on Kotak Mahindra Bank.
Okay, Ashwini, just one follow-up. United Spirits, thoughts here, 3% higher.
See, United Spirits, 4,000 is a line in the sand. Once that gets taken out, I think another leg of upside will start on United Spirits. So I would think that the first leg of 3,000 to 4,000 is over, and the next leg we should see, maybe 4,800 to 5,000. So United Spirits is now continuing its expansion which started earlier.
Okay, well, thanks for that, gentlemen. We'll come back to you, but there's a listing that is expected. Yeah, it's done. There's a listing that is expected just in moments from now. I think the first tick has come in for Apollo Microsystems. Remember, the issue price was 275. I think the listing has happened at a very, very strong premium, 68% premium to the issue price. 465 is where it's at. Remember, this company had a very good subscription as well, 248 times subscribed, and it is in the, it provides integrated solutions to a whole host of sectors, aerospace, defense, etc. Krishna Sai Kumar, the director of Apollo Microsystems, joins in on the phone line to talk about that. Mr. Sai Kumar, good morning. Congratulations on a strong listing. I just want to ask you what the expectation is as far as order book and revenue growth is concerned over the next 1 to 2 years.
Thank you very much. I would like to thank all the investors on this listing day, for showing a lot of response on the stock and, believing in the company and our future prospects.
Yeah. Mr. Kumar, can you hear us?
Yeah.
No,
Yeah.
We just want to have an idea now that the listing is done and you're free to talk about the future prospects of your company. You have shown a very huge growth in the past several years. In fact, in FY17 itself, your growth has been what 30% or so in terms of sales. And in terms of profit before tax, you have doubled. From 14.5 crores to 27 crores, and again profit after tax as well. It's an 80% growth. Is this a maintainable?
I would say we would show a better result compared to last financial year 2017. As you know that the funds have just flown in, and a remarkable performance improvement will be posted only in the next financial year, although we will improve upon our financials to the last year.
Okay. Mr. Kumar, good morning. So what are your key markets and key products, and what kind of growth do you expect?
As I told, primarily our primary market is defense sector actually, and we provide electronics and solutions for the various defense programs. And there is a strong growth, in the sector overall, and a lot of indigenization, and Make in India, which
the order book now? What's the order book now in the defense sector?
Pardon me?
What is the order book currently in the defense sector?
We have close to around 125 crore plus of order book as on date.
Okay. You gave me only a qualitative guidance for the future. Can you give us something more concrete in terms of your revenue and, say, EBITDA growth, given the kind of order book?
Very shortly, we will give more specific, details of, where we are heading and all, good announcements would also be coming down the line. And we are also part of, the first indigenous weapon export, which the country is doing. We are doing a major participation in that.
Okay.
And we'll keep, giving the market the feelers of major events that come down the line.
Sure.
So all right. Okay. All right. Thanks a lot for joining us. We've run out of time, but thank you for joining us. That's actually a stellar listing. Apollo Micro up almost about 61%, and the order book at 125 crores, primarily from the defense sector.
It's small base, but still it's like an 80% run rate in terms of EBITDA growth, and 30 to 40% growth in terms of top line growth.
And these are sunrise sectors, right? Defense, etc., that are picking up pace. Moving on though, HDFC Life posted a good set of earnings as well. That stock has been moving with strength. Here's more from Yash Jain, our colleague. He had a chat with Amitabh Chaudhary, the MD and CEO of the company. So let's listen in to what he had to say.
If you look at our overall premium, that grew at 20%, but if you were to break down that number into various elements, our individual WRP grew at a rate of 46%. Our group credit protect, which is the protection side of the business from a group perspective, grew at 57%. Our renewal premium growth was about 10%, and our group funded side of the business was flat. I mean, it did not grow, but that is reflective of what the industry is. So our overall number was 146 billion rupees of premium income which came in comparison to 122 billion rupees of last year. So for the first 9 months, we had a pretty robust and a solid growth quarter, and 9 months in comparison to the industry. If you were to kind of break down into some of the other matrices, I think we are quite delighted with what we have delivered. Our margins were at 22.2% in comparison to 22% last year. Our return on embedded value was 20.4% and compared to 18.4% last year. Return on equity was close to 25%. Persistency moved up from 83 to 86. Embedded value grew by 26%. Our Our Indian GAAP profits moved up at 18%. We declared a dividend of 330 crores in this quarter. Our solvency margin was at 190%. So if you look at the overall kind of mix or bouquet of financial metrics, we are very happy with where we are.
What would be some of the factors to which you would want to attribute this strong growth to? Is there any sort of change in the strategy which you're working with, which has led to this growth? Which would be some of those factors?
So a couple of things which worked in our favor. First is that please note and understand our last year was not such a great year for us because our bank insurance channel, which accounts for a big portion of our sales, did not do as well for some very obvious reasons which have been outlined in the past. So first is there is a bit of a base effect which is kicking in. But second and more importantly, we had said in our IPO and we had said in our investor presentations that in this year we're going to invest in certain businesses in a very, very big way. So agency has been an area of investment for us. Online obviously has been an area of investment for us forever. We are the pioneers in that space. Group Credit Protect obviously is something which we have taken the market by storm, and we are a market leader by a margin. So as we have invested in certain channels, as we have invested in continuing to add more bank insurance partnerships, they went up from 125 to 139. Our new ecosystem partners went up by 7 to about 21 partners. So we have continued to add to our bank insurance space. We have continued to invest in some of the other channels. And yes, we also saw a little bit of growth in ULIP, reflective of what is happening in the market. So all these factors added to a very good growth for the first 9 months.
Talking about the persistency ratio, your 61-month persistency ratio slightly dropped on a sequential as well as a year-on-year basis, more so on a year-on-year basis. What were the key reasons for that slight drop which we saw there?
Thanks for asking the question. You're absolutely right. Our 61st month persistency did drop. But the reason why it dropped is if you go back to 2013, the products which we sold at that time, the 13-month persistency was also lower. So this particular cohort of business which we did in that last year, which is playing through in 13th, 25th, and now 61st month. Right. As this business goes off, our 61st month persistency, the 49th month will become 61st month next year. And that number is doing very, very well. So the 61st month persistency will come back.
We should hold Amitabh Chaudhary to his word on this. I mean, 61-month persistency for all policies is, for many companies, is not very impressive. People are staying for 13 months, but they're not staying beyond 5 years. Yeah. We should see if Amitabh Chaudhary is right that in 2 years this trend will change.